Hi, the other day I exchanged this for one of these, a silver coin, a 1 ounce silver coin. Cost me about £40. I couldn't get it a lot cheaper if I buy in bulk, but I bought this from a local shop to support them. But which do you think in 10 years' time will be worth more? Which will have the most buying power, this or this? Well, I know it won't be this. This is cash, right? And this is an asset. This is silver. And the price of silver, gold and other assets have gone up much faster over time than cash, right? That's a fact. And we know that cash itself is being depleted by something called inflation. They say the official inflation rate in the UK is 4%, but I don't think it's anything like 4%. We know how much things have gone up in the last year or two, so forget 4%. Even if we say it's 10%, you know, your money in the bank is losing 10% a year in terms of buying power. Think about this. Think about a time when you maybe bought a house, what you paid for that house 10, 20, 30 years ago. Okay? Think about gold. I mean, I was able to buy gold in the 90s for a 1 ounce coin for about £200. Now it's more like £1,650 or $2,000. It's gone up 500% in the last 30 years. And think about money. Think about that £200 I had then and what it would buy me then compared to what it would buy me now. I mean, £40 now, you know, barely buys you a meal in London, right? You know, it will barely buy you a meal in London. But in 10 times, you know, in 10 years' time, it will probably buy you a couple of Starbucks and a sandwich or something. So money loses value. There was a time when this was currency. Currency was gold coins. In the Roman coins, you find silver and gold coins. Then they started depleting them. They started taking the silver out of the coins, and that started the downfall of their empire. In more recent times, then they exchanged what was gold. Instead of carrying around gold, they said, right, we will hold the gold in this vault and we will give you this promissory note to be able to exchange this note for the equivalent in gold in the future. And that's how this money started in terms of paper money. Then the people who had the paper money found that, well, not many people are coming back for their gold very often, so maybe we can lend out the gold or lend out the equivalent of the gold to other people while we're holding it. That was the start of fractional reserve banking. Okay, but now and of course, in my lifetime, there were times when a note, a £5 note or something, said you can exchange this for the equivalent in gold at the Bank of England. But that's gone now. That link to gold has gone. This is just paper now. They print this stuff. It's just, you know, quantitative easing. They print billions and trillions of this. The national debt in the US is over 30 trillion. In the UK, it's nearly 3 trillion. You know what a trillion is? It's a million. A trillion is a million, right? £1 million times a million is a trillion. It's an unbelievable number. And the debts now are running into trillions, not billions. I mean, they throw trillions around and billions around. I mean, like it's confetti. Oh, we'll spend $1 billion on this, $1 billion on that. We'll send $1 billion for this war and $1 billion for that war. You know, so the national debt is going up so much that this is also deflating and reducing the value, the real buying power of paper money. And of course, we need paper money. We need to have some in the bank, but I wouldn't leave too much lying around. Of course, you need maybe 6 months of expenses in paper money in the bank, but you certainly wouldn't want to leave it around very often because they're paying something like 1, 2, 3% on some of their accounts, and they're lending that money out at anything up to 40%. 22% for a credit card, up to 40% for an overdraft, right? So they're making money on your money. So you don't want to leave too much of it lying around in the bank. You should be investing the majority of your money into assets. That could be commodities like gold and silver. It could be property. It could be stocks and shares. The stock market has done very well over the past 100 years. And you don't need to pick the individual stocks. You can go into funds. You can go into index funds. So always, you know, have a proportion of your money in assets. Otherwise, it's losing value over time. So that's just a quick message for you about investing in assets. If you want to know more about investing, becoming financially free, check out my webinars. I'll put a link up to the end at the end, and it's usually on a Wednesday night, 7 p.m. ish. And check out my webinars, and I'll go through the 3 steps you need to become financially free. Thanks a lot. Bye for now.